The headline number for the Consumer Price Index, or CPI, has fallen from a peak of 9.1% in June of 2022 to just 4.9% in April 2023. Of course, that's good news, but is it good enough for the Federal Reserve to stop raising interest rates? Today, the RLS boys consider the possibility that the way the CPI numbers are calculated could be masking a true inflation rate that is actually even lower, perhaps in the low to mid 2% range, which is very near the Fed's expressed target of 2%. Stay tuned as we look at the numbers and what they might mean for the Fed, the markets, and you right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm one of your co-hosts, Adrian Nicholson, and I'm joined by my other fellow co-hosts, Roshan Loungani and Erik Olson. Today, we have a really exciting episode. We're going to talk about if the inflation battle has been won or do we still have a long way to go. So we're just going to dive right into today's episode. So Erik, do you want to start us off and let our listeners and viewers know why we're talking about this topic today and why it's important?
Yes, absolutely. So listeners, number one, we approach this both as an investment advisors and as financial planners. And the question is, are we still in a long-term battle with a sustained high level of inflation? Or has the battle mostly been won if we look inside some of these data? And if it has been won, then what can we both do on the investment side and on the planning side with these revised assumptions? I'll also just toss in that I think it's also useful for us as citizens of a democracy, or at least a federal republic in which we vote for people. If we can have a better understanding of how economics actually work, then we're in a better position to cast our votes wisely for people who seem to share that particular economic outlook and who undertake policies at the federal and state levels that will align with these long-term policy aims that I think we all share, which is low inflation, steady growth, and a prosperous society. So with that, we've got a few bits of data to share with you. And this, as far as I'm concerned, doesn't really need to be a very long episode, although maybe some of the things I'll present to you, Roshan, and you, Adrian, you'll take issue with, in which case then maybe we elongate this conversation a little bit. But for our listener and for our viewer, what I wanted to say is that I think for the most part that the inflation battle has in fact been accomplished. And I'm not saying that in that statement that it's necessarily a result of Federal Reserve action, which has been the most, at least, prominent actor in attempting to address this, both in the primarily in the process of raising interest rates and secondarily in stopping the fiscal stimulus, or pardon me, the quantitative easing process that they had been engaged in for so many years, coming out of the great financial crisis back in 2008 and 9. Instead, it may have happened in spite of them. And so to understand this, here's my basic argument. And then, gentlemen, you can take issue with it. And I'll show some data as well to support this. That in essence, the inflation that we have had is a byproduct not of spending, although I hate spending. I hate excessive spending. And I think it in the long run undermines our ability as a nation to be prosperous, and instead substitutes federal stimulus for what would be economic growth in the private sector. But it has not been the inflation per se that has driven this. It has been instead the supply shock coming out of the pandemic, and then the response to that with various policy actions. Among them, the decision to, at one level, lock things down. This is a global phenomenon, not just a U.S. phenomenon, but as a result, to interrupt that process of creating goods that people actually would buy. And then coupled with that as well, then putting a lot of money into people's hands in the context of a limited supply. More dollars chasing fewer goods and services produces this run on inflation. So with that, why am I arguing that I think we're largely out of it? And that is to make this argument in the nutshell version. If you look at the several measures of inflation that we commonly consult, those include the producer price index, the consumer price index, and the personal consumption expenditures index. When we look at those three things, what we see is number one, they've come down a lot. Number two, especially in CPI, if you understand how it's built, you understand that 40% of the core CPI measure is deemed to be shelter, and 34.4% of the headline version of CPI, which includes food and energy, is also shelter. Shelter, along with food, but shelter in particular, has a relatively, as you've just heard, big contribution to this index, and it is high, but I'm not sure that it's actually high. And the reason I say that is that the way in which shelter oftentimes is measured is using apartment rent equivalents. And for most of you who have ever rented an apartment know that your lease wasn't day to day or month to month. It was an annualized lease. And so as a result, the numbers that you're seeing in the most recent reporting period, they were in mid-May for the end of April, those would reflect leases that had been undertaken sometime as late as early as May 1st of last year. And it's no big surprise that that those leases were higher than the ones from April and before. So during that phase, it was totally understandable that leases would be going up on that level. But if you look at what people are paying today for new apartments that are, they're undertaking new leases and what they're paying on their leases for those rentals, for the most part, that's about, give or take 2%. It's about the same pricing as it was a year ago. So if you take shelter and you reduce it from its measured level down to something closer to 0, possibly -2, possibly +2, and you stick that back into the CPI formula, whether the headline version at 34.4% weight or at the core version with 40% weight, what you get is then the math on the entirety of of that is about somewhere between 2.2 and 2.8%. 2.2 to 2.8% if that measurement of shelter is substituted. And if it is substituted, interestingly enough, that matches very closely with where the PPI has been, producer price index has been on a trailing 12-month basis. That's at 2.3. So my argument is we're not quite at the precise 2% level that the Federal Reserve has indicated is their target, but we're in reality, I believe, a heck of a lot closer than what the gross numbers are showing of in the mid fours. And as a result, I think we're in a lot better shape than what commonly is being argued. There's my basic view on this, gentlemen.
So let me ask you about this. Your adjustment to the PC or CPI of shelter is what's causing you to think we're at the target.
Close to it. If you take out the measured level of shelter, and I can share my screen and show you what that chart looks like, and substitute for it what I believe is take out the CPI studies and just look at actual what people are reporting that they're paying for rents versus what they were paying a year ago. That inflation level on apartment rental increases is in the neighborhood of 0% increase, not at the elevated level that shelter is showing of about 8 on the CPI measurement.
So why is your number right and the reported number wrong?
The reported number isn't wrong; it's just lagged. Okay. So it's using an environment of measurement where you say if you're comparing 12-month leases, well, those 12-month leases haven't reset. If we fast forward 2 or 3 months and we now see leases where much of that the starting measurement point is now higher and the ending measurement point is not running higher, then you'll see, I think in short order, a few months that shelter's contribution to this elevated CPI has come way down. So I think if the Fed could say, yes, we understand we are committed to using these tools, but the reality is in this unique situation that indeed shelter isn't rising at that same level that our measurements are representing it as rising, then maybe we're already about where we need to be and we can adjust our policy actions accordingly.
How much of a lag is there?
Well, I guess it's everyone's experience with how long a lease they write is going to be a little different. I think it's the most common length of a lease is a 12-month lease. So if you have a five-year lease, I suppose, at a fixed payment, that would be a different story. But I would say probably about 12 months is a good general statement about the ordinary length of leases.
So no, when I was asking about the lag, I meant so you're saying in 12 months the CPI will be down to 2 because that lag will then be gone from the data you're using.
Yeah, I'm saying that that I think, in fact, shelter isn't, aside from the resets on the leases that are still being measured. If you look, roughly speaking, about a year ago and look what rental rates were and compare them to what they are today, you would say, wow, it doesn't look like there's this shocking upward march in rental prices. And as a result, that along with all the other elements of the CPI, which are the constituent parts of the CPI, which aren't on that showing that sort of upward march that shelter is showing. There's some of them are still high, but some of them are low. And by the way, I mentioned about producer prices. Producer prices, I think, on the goods level are actually negative. We're seeing declining prices on the goods portion of the producer price index, not so much on the services side, but on the producer goods side, that's coming down too. So anyway, those are the inputs into this, sort of thinking about it mathematically.
Mm-hmm. Yeah, there's also one input too that I'm not sure may or may not impact some of the data that you're presenting as well, Eric, but I know something that's going to play a significant factor in this is the labor market as well. When I was researching for the podcast, that's something that a lot of people are just going to be keeping their eyes on as well, because that really still is at a reasonable level right now, where I think the unemployment's around the 3% neighborhood. And right now they're showing that job openings are still fairly strong. People are still looking at employment. I know that's got to play a significant factor on how inflation really plays out along with wage growth. So that too is something that investors should really take a look at to see how that will really impact inflation. I do agree with you where inflation right now is better, but to really get to that target level, to really get to those levels that we saw a couple of years ago, it really is going to take, whether it's more interest rates, the labor market changing, whatever it may be, to get us to that target, where I do think we still have some time to go for me to say that inflation really is better now.
Fair enough. I mean, I agree with you that wage pressure is higher, but also, well, I didn't go out. I was looking at CPI, PCE, PPE, PPI, those three measures: consumer price index, personal consumption expenditures, and producer price index. That while I recognize that, which I think is fantastic, actually, that there's high levels of employment, increasing participation in labor rate or labor force participation rates. That's, I think, great. Why would we want to throw people out of work to fix inflation? It just seems so perverse to me. But in this particular case, while there's been sustained and increasing labor force participation, I also believe that we haven't been seeing the same rate of wage growth that we had been seeing. So in terms of as a contribution to the producer price index, which is where you'll normally find the wage element starting to have an impact, that and producer prices, it's producers who are the ones that are paying the wages. So on that basis, if you look at overall right now, total in PPI measurement at this point is 2.3 as of the end of April. If you take out food, energy, and trade services, it's 3.4. That's a little higher, but it's also a smoother curve. It doesn't vacillate quite as much as the version that does include foods, energy, and trade services. So on that basis, I'm not saying we're quite at 2%, but I think we're a lot closer than the numbers seem to be indicating.
What does that indicate then? Are you of the opinion that the rate hikes are done?
I would think that they should be done. And actually, as you've heard me say before, I believe that the key thing that the Fed should have been managing along the way is money supply, um, because the interaction of money supply and the amount of and its velocity coupled with price levels and the availability of goods generally, those are the things that work together to, I believe, drive prices and inflation. But nevertheless, since I think that the markets, not the Fed, should set interest rates, I think it would be a beautiful thing for the country if the Federal Reserve just said, okay, we're going to get out of the business of raising rates right now, and we're going to just allow the markets to dictate the natural price level for all of this, for borrowing.
Yeah, I'm sure the people at Silicon Valley Bank would have been happier if they went that route too.
Yes.
Yeah, it's interesting because I'm last week. So we're recording this on the 24th of May. Last week there were a bunch of members of the Fed that came out, and you were getting a mixed bag of people saying we need to pause versus people saying we need to raise rates. I think the last data point I saw was there was an 80% expectation that rates would not be going up. So I think your data, Eric, would argue for that as well. I'm of the believer that they're going to at least pause, and I hope you're right and it comes back down, especially with all the other risks out there in the market right now.
Yeah.
From banking to debt ceiling, et cetera.
Yes. Well said. Let me, if you don't mind, I'll share my screen here and just show the difference between the all items version of the consumer price index and then the shelter version. And I think that will help explain what I mean by this. So if you're a listener, we'll have in the show notes the link to the chart at the Bureau of Labor Statistics that shows this. But what I'll do here for our YouTube viewers is go ahead and share this screen, and we'll go from there. Let's see here. So here you'll see in the red the consumer price index inclusive of everything, and there's no seasonal adjustment to this. And this is going all the way back to April of 2003. So this is a 20-year inflation, or at least CPI chart. And you can see that for the most part, following the global financial crisis, as things emerged and were actually slightly negative in the early part of 2009, that rate has floated somewhere around the 2% area for a long, long time. Then coming out of the pandemic with the supply shock, and then on the aftermath of that, more stimulus, what you saw was that the consumer price index broadly shot up, as we all know, at that peak level in July, I guess it was, or June, I guess it was, of last year. It was at 9.1. Now, on the right-hand side, it is at the end of March, it's at 5, and at the end of April, it's at 4.9. But look at what shelter is doing. So shelter right now, the purple line over here at the end of April was at 8.1. And if that's 30% of the index, again, and if you take that out and you say that actually should be a much lower number, probably, then what that would do is take this line and reduce it by whatever amount the shelter component was reduced times 34.4%, meaning 34.4% of the reduction of shelter to what would be perhaps a more appropriate level brings this number from 4.9 down into something lower, and conceivably something as low as under 3, close to 2 possibly.
Yeah, and that shelter data, you're saying is just lagging too far behind. 2022 rents for someone whose lease renewed in 2023, you're saying has not actually gone up 8%.
I would say if you looked at a lease set somewhere in the summer of 2022, when they reset that in summer of 2023, remember the peak for everything was in June. So I think you get to June or just the other side of June, and then you see what's taking place with those shelter numbers. It won't look like this 8.1. And so,
do you think there'll be a big decline?
I think there will be a big decline. Of course, now I'm saying I have a crystal ball. I don't have a crystal ball, but it is it is it's that lag effect. So if you're looking at things that were maybe here set, especially let's say here in November of 2021, then those did go up a lot through November of 2022. That, there was obviously on shelter in November of 2021 was against the year before was increasing at 3.8. And if we go to November of 2022, it was 7.1% higher than in November of 2021. That's big, but that understandably that's big. But this lag effect, can you see, for example, I don't mean to get too deep into the weeds on this, but to explain the lag. So here you see the bottoming of the CPI back in 2009 was in July of 2009. It was at negative 2.1. Shelter had its bottoming part in June of 2010. So the difference between those is about an 11-month bottoming process. That's, I believe, a lag effect. Here, let's look over here. The bottoming process of CPI in the wake of COVID, this was in May of 2020, CPI at that point was 0.1. The bottoming process of shelter was in February of 2021. So it went from May to February. That was about a 9-month lag, where it reflected in the housing numbers that are used for this study, it reflected that decline. So I suspect that when we get about 9 to 12 months past this June 2022 number, and we're
there
at
really.
the 9-month level, not quite at the 12-month level.
Yeah.
But when in this neighborhood of where we are right now, what you'll see, and you can already see it
looks like it's starting to
tiny flattening. Yeah. Which is the first meaningfully, not a meaningful decline, but at least observable decline since this whole thing started skyrocketing in February of 2021. So for basically not quite 2.5 years to just have it be going straight up. And now we're having this inflection. It looks like it's tipping and rolling over. I think that's a sign of good things to come, and that the numbers that we'll see shortly will be very encouraging to us all. So that, all of this, as I said, is relevant as an investor. It's relevant as a planner, because of the planning assumptions that we use for long-term inflation have a great bearing on people's financial planning outcomes. But it is also, I think, as a voter, there's also that element as well. So if we can sort of shift our thinking to say, maybe we're not in as long-term a pickle on the inflation side as I think we're in a pickle in other ways, but if we're not as much as a pickle on the inflation side, obviously where we can find good news, we shouldn't, just be perma pessimists.
Well, and what this has got me thinking too is not just the pause for rate hikes, but if you get that kind of precipitous drop as we did before on the CPI numbers on this chart you're showing, is there a rate cut coming? Like, there have been many people talking about a rate cut later this year, and this could be a path to that. I'm not saying that's happening. This could be a path to that happening.
It certainly could be a path to that happening. And if you were to listen to the pundits, you'd hear people saying perhaps we'll see a cut as early as July, at the July meeting.
I mean, we'll see. I'm still of the camp that it won't happen this year, but I hope I'm wrong.
I hope as a person who's considering purchasing a commercial building for an office here in West Michigan, yes, I would like rates to come down. As someone who, though, is at just a greater polity level, I would think it's great if the Federal Reserve would just say, we have had such hubris to think that it's our role to constantly be tinkering with these rates. Let's let the market set the rates. That would be so much healthier for us all.
Yeah, that to me seems so foreign that it's not even. To me, that's not even a possibility. I hope I'm wrong with that too. But they're always adjusting the rates and trying to manage the economy. I just don't see that stopping anytime soon. Now, the argument for that is we've had such low rates since 2009 that this is their opportunity to do that. So let's see. I hope you're right, but not holding my breath for that one.
Well, what I wish for and what I think will be are completely different things. So I have no expectation that the Fed is listening to our podcast and saying, you know what, those guys have made a good argument. Let's get out of this business. I don't think that's likely.
Yeah, I don't think we're the first to make that argument either.
That's true indeed.
So,
well, I don't really have anything else. I just thought that this was an encouraging bit of data and something that our listeners might appreciate having brought to their attention.
well, and Eric, I hope you're right. Thank you for doing this analysis and sharing it with us and everyone viewing and listening. This has been another episode of the Retirement Lifestyle Show. Please like, subscribe, give us 5 stars, tell your friends and family, and we'll be back next week with a great episode.